there, this is Nida from Count On Us. Want to learn accounting? You are in the right place. Today's topic is Gaap in accounting. Before that, this is the first time you are here. Start now by subscribing and clicking the bell icon to not miss out anything. Let's begin. Gaap means generally accepted accounting principle. In simply, Gaap are the rules for the preparation of financial statements. Every publicly traded companies must release their financial statements each year. These statements are used by the investors, banks, and creditors to determine the financial health of the company and its suitability for investment or extension of credit. In order to properly compare and evaluate the company and their results, financial statements must provide similar information in a similar format. For these reasons, companies must follow Gaap in accounting, especially in publicly traded companies. Now we are moving to the main principles of accounting. There are 10 main principles in accounting. To remember those principles easily, there is a secret tip. Hello friends, Munchy, Crunchy, Munchy, million big tall rats on the ground. What it means? H stands for historical cost, F stands for full disclosure, M stands for materiality, C stands for conservatism, M stands for monetary unit, again M stands for matching principle, B stands for business entity, T stands for time period, R stands for revenue recognition, and finally G stands for going concern. Now we are going to first principle of accounting, that is historical cost. Historical cost means acquisition cost. All the business transactions should be recorded, not only the purchase cost but also the expenses incurred in bringing them to the intended location and making them ready to use. Second principle is a full disclosure. This concept is very important because majority of business are organized as joint stock companies. In such cases, there is a separation between ownership and management. The shareholders are not taking active part in the day-to-day business activities, so the management should provide all information through the published financial statements. That statements must cover the explanation of a full material fact like how the valuation of a stock conducted, the methods of depreciation, contingent liabilities, etc. Third principle is materiality. It states that we need to focus only material fact. For example, while sending the debtor statement of account to the management, the figures may be rounded off to the nearest 10 or 100. Fourth principle is conservatism. It is also called prudence. So let's see what this principle. It states that while recording business transactions, we should only consider the possible losses. It is especially applicable in current assets. This is also called the policy of playing safe. For example, provision is made for possible bad and doubtful debt against current year's profit. Fifth principle is monetary unit. This means only record the transactions in the form of money or money's worth. For example, if a business has a team of qualified, experienced and dedicated employees, it is definitely an asset to the business. But since their value which cannot be monetarily expressed, they are not shown in the books of account. Next principle is matching principle. This means revenue of a particular period should be compared with the expenses incurred for earning that revenue. The question of when the payment was made or receipt obtained has no relevance here. It is because of this concept that the adjustment was made for outstanding expenses, accrued incomes, prepayments, unearned incomes, etc. while preparing final account at the end of an accounting period. Seventh concept is business entity concept. Business owner has separate existence from his business. For example, the capital invested by the business owner into the business is considered to be a loan given by him to the business. So it is credited to his personal account in the name of a capital account. In case this concept is not followed, business affairs will be mixed up with the private affairs of the business owner and the true picture of the business won't be available. So keep in mind that every business has separate existence from the owner in the viewpoint of accounting only, but not in the eyes of law. The next concept is a time period. The business is supposed to continue for a longer period of time, isn't it? It is absolutely necessary that after a time interval, businessman must stop and see how things are going on, so that only he can analyze the profit and financial position of the business and take the appropriate decisions accordingly. The time period may be monthly, quarterly, or annually. Another concept is revenue recognition. Revenue recognition is figuring out when a business has actually earned its revenue. If the business uses cash basis of accounting, that's very easy. You earn your revenue when cash hits your cash register or bank account. It is different for business that use accrual basis accounting. Under accrual basis, we recognize revenue only when it has been earned, not when cash is received. The last concept is going concern. It is assumed that the business will last for a longer period. Because of this concept, fixed assets are recorded at original cost and are depreciated in a systematic manner. If not following this concept, the entire cost of asset will be charged to the profit and loss account.